why I'm not all that worried about sequence of returns risk. Hi, it's financial planner Sean Mullaney. Let's discuss. So, especially for early retirees, this sequence of returns risk is real, but it's not something I worry about all that much. And, it's this risk that you start retirement, you then sell assets, stocks, bonds, mutual funds into down markets, and that could cripple your chance of financial success, particularly in an early retirement. Well, I've got 5 main reasons I'm not all that worried about sequence of returns risk. The first one is diversification, right? So think about a well-diversified investor. What is he or she essentially buying, right? I'm not giving you investment advice, but just consider a well-diversified investor. They're buying the market. Well, in an environment where the entire market is down, other things are happening. One, it might be that policymakers are stimulating the economy, and that could offset downside effects of sequence of return risk early in retirement. But you also have an environment where maybe retirees are spending less, and business travel to clients and conferences are down, and you don't have all these people bidding up the price of goods and services. Essentially, the rest of the world will be reacting in a situation where the entire stock market is significantly down. And so that's a big part of the reason I don't worry about sequence of returns risk that much. Not that it's a nothing, but if we're diversified, we're hitching our wagon to the overall economy. If the overall economy is going down, other things are going to happen, and a lot of those other things are probably going to mitigate the downside effects of sequence of return risk on us. Now, I will say, if you're 80% concentrated in XYZ stock, well, now you've got massive sequence of returns risk, because the price of steak at the grocery store, or the price of airfare, or the price of a hotel room could care less about one particular company and their latest scandal, or a competitor put them out of business, or anything like that, right? So sequence of return risk is highly magnified when we're undiversified. But when we're diversified and we're hitching our wagon to the rest of the economy, that itself tends to mitigate sequence of return risk for retirees. Second reason I'm not that worried about sequence of return risk, easy for me to say, is Social Security. Even early retirees tend to have decent Social Security earnings history and potential future benefits. And so that does 2 things. One, it's an income stream that is not subject to sequence of return risk. So that itself helps mitigate sequence of return risk. And 2, Social Security in the future is going to reduce our dependence on those assets that are subject to sequence of return risk. So that's a second reason I'm not that worried about sequence of return risk. The third one is a point Michael Kitces had years ago on the Bigger Pockets Money podcast, which is this: you are not just going to blindly march off the cliff, right? When we think about sequence of return risk, safe withdrawal rates, right? The academic assumptions just sort of have to assume, well, the retiree is going to march off the cliff. That will not happen, right? Both consciously and subconsciously, we all make adjustments to our spending, particularly if we know, hey, the economy's down, the stock market's down. Well, maybe you eat out less one night a week. Maybe a 14-day international vacation becomes a 10-day domestic vacation. Maybe a new Camry becomes a new Corolla becomes a used Corolla. There are these subtle adjustments that we can make to our living expenses that don't have that much impact on lived experience in terms of quality, but can help mitigate sequence of return risk. So you're not going to march off the cliff. Do not worry about that. What about number 4 is we've seen this. And look, there's no 100% guarantee that U.S. international equities are going to be marching up. But history is pretty helpful here. And just think about it. I did a blog post. I'll link to it down below. Thought about a couple that retired on December 31st, 2007. And in the next year, the S&P 500, I think, lost something like 38% in the year 2008. And from that low, it's up, I think, 6 times now. It's about 6,000. I'm recording this in mid-June 2025. I haven't looked up the latest number, but I know the S&P 500 is near 6,000, in that range. And, you say, well, okay, how did that couple do with sequence return risk? Yes, get bit, and now they're probably doing just fine. They're probably upgrading their airfare. So they've gone through it. It bit hard, and they steadied the ship, and they're probably doing better in retirement. I think we've seen it happen. We even saw it in March and April of this year, and it didn't have, it was, oh no, this time's different and all that jazz. And it bounced back. Now, it bounced back sooner than I would have guessed, but, you never know with the stock market. And then the last one is one of the most popular sequence of return risk mitigation tactics is, all right, I'll just go into retirement with 2 or 3 years of cash. Well, cash has its own problems, right? It has drag if we have too much of it because it reduces expected return. But it also has inflation risk, right? That cash, the value of it can be inflated away. And oh, by the way, if it's in a taxable account, it could generate 4 or 5% interest income. That's inefficient from a tax perspective. So look, sequence of return risk is real. But for diversified investors, I believe it's not that big of a consideration when we think about early retirement and portfolio consideration, right? And I think the 5 factors I talked about seriously mitigate against the downside effects of sequence of return risk. But let me know what you think in the comments. Do you think I'm missing the boat, or do you think I'm too pessimistic, right? Am I too optimistic, too pessimistic? Let me know in the comments below. Thanks so much for watching. If you enjoyed this video, please mash that like button and subscribe to my channel. I'll see you next time.